Let's bring in David Lebovitz, global market strategist at JPMorgan Asset Management. Of course, that's not the only story, David. You've also got all the sensitivity around Fed hiking, how fast, how soon, how big they're going to go. What do investors do with all that right now?
So I think it's important to take a step back, and investors need to not as much focus on what is happening right here and now, and rather think about the implications of the potential resolution to Russia-Ukraine, a potential clarity on what the Fed is going to do. We really need to look forward at a time where I think a lot of people are very much caught up in the moment. And, you know, what seems to be causing the market a bit of consternation and angst today is this idea that we're dealing with higher energy prices. We're dealing with a Fed which is going to become more hawkish. We obviously have geopolitical risks bubbling in the background. And I think you're beginning to see some concern build around the outlook for growth, particularly in light of that consumer sentiment report last Friday. But, you know, I want to go back to the Fed meeting in January, where, you know, Jay Powell was very clear that they were going to react as the data came through the door. And so I think investors need to recognize that if growth does begin to slow because of, say, higher energy prices, the Fed isn't on a preset course here. They're going to adjust policy accordingly. And so there's no shortage of uncertainty, but I do think that investors may be a little bit too pessimistic as they look ahead here.
In the short term, though, do you expect 50 basis points in March? And is that going to be something that will create more volatility as we get there, or have expectations priced that in sufficiently already?
So I think that the Fed has the market right where it wants it. Not only is it pricing in a 25 basis point hike, but we're close to pricing in a full 50 basis point hike as well. I don't really see the Fed moving 50 basis points right off the bat in March. I think if they do, it's because they feel a need to get rates higher and get rates higher very quickly. And I actually think that would likely be followed up by another 50 basis point hike at the May meeting in an effort to, again, just raise the absolute level of rates. And so I think that the Fed's going to dive in here 25 basis points in March. I don't think that an intra-meeting hike is going to materialize. And we do see room for them to hike sequentially in March, May, and June. I do think at that point, though, the Fed's going to want to come up, take a breath, and see what the economic landscape looks like. Because, again, there are a number of wild cards, like higher energy prices, that can materially affect the economy during the second half of this year.
So if you think the market's overreacting, on the negative side, David, what looks most attractive to you? What parts of the market?
Of course. So, you know, we're in a world where rates are rising, and we recognize that the way that rates pressure equities is vis-a-vis valuations. And so we're very much in an environment where we're focused on price to earnings growth. We want the earnings to be there. We think the days of the story stocks and swinging for the fences are very much behind us. We're also intrigued with companies that have large fixed costs. That means that they'll have a lot of operating leverage if the nominal growth environment this year plays out the way we're expecting. And so, again, that does lead us to lean more into value, things like industrials, materials, financials, but we're not necessarily abandoning the growthier parts of the market. We continue to think that healthcare looks very interesting, particularly if the pandemic does in fact begin to fade. And then everybody's talking in absolute terms about technology. We need to recognize that there is an enormous relative opportunity, and the difference between the companies in the technology sector that earn money and the companies that do not is fairly significant. And so again, we're very much using earnings as a guide when it comes to investment strategy this year.